Hey, in this video, we're gonna get started with investing. And how do you get started with investing? Well, you need a brokerage. So let's look at brokerages. So this is actually a really good time to start looking into brokerages, especially if you're a new investor. What brokerage should you choose? Is it important? Kind of is important. Why is it important? And why is it a good time to learn and look at different brokerages right now? Well, all the brokerages are on a race to $0 trades. $0 trades. And that's super cool because if you're just starting out investing specifically, if you only have $100 or a few $100s and you want to buy some stocks or an ETF, that's usually, at least right now, before this $0 trades across the board goes into effect for a lot of the big brokerages out there, $7 is a pretty typical trade, and that's like 7% of $100 if you wanted to buy a stock. And what's so significant about that is that that's like about the average performance of the S&P 500. So it's like a whole year is wiped out. And you are investing in stocks and ETFs is a risky thing to do. So you not only have that whole year knocked off on average, that's the average performance of the S&P 500. And then you have the risk of what if it doesn't go up that much in a year. So that's why free trades is so important especially for new investors. And what's been filling the void for that for the past few years? Well, Robinhood. And that's a big reason why this is starting to happen. So Robinhood and M1 Finance and other new startup-like brokerage platforms that have been showing up has been really attracting the millennials in signing up for free and starting to trade with no costs. And because of the fact that if you just have a few $100s, again, free trades. And that's a big deal for when you starting out. And the downside, though, with those always have been is that if you are looking into the future of this account when it's going to be 100,000, hundreds of thousands, even millions of dollars, do you really want that much money in a super new platform that's not really recognized and that hasn't been proven and true for the test of time, like Robinhood and M1 Finance? In general, if you're dealing with that much money, you want to go for the best. You want the best platform, the one that's never going to go away, and so that you never have to file some claims, and a lot of times these platforms only insure you up to $250,000. So there's a lot of different things that you might not want to invest with these free trade platforms that are out there. But again, if you're just starting to invest in only a few $100s to invest, it's actually super useful because you don't have to lose so much money just for that one trade. Now, what's been going on right now? Well, Charles Schwab just announced that they're going to do $0 in trade fees. And so that includes stocks, ETFs, options. And so that's pretty exciting. And so let's just jump into Charles Schwab right now. Are they a good one to look at? Well, the good thing about Charles Schwab is that those commissions that they would make only accounted for about 6% roughly of their net revenue. And in terms of the brokerages that are just starting out with the zero trade deal, it's the lowest total revenue by percent for the other ones, and the other ones being TD Ameritrade and E-Trade. So that's a good thing to know that it's not taking that big of a hit for the free trades, and we're not even talking about how much more subscribers they're going to have and more money just laying around and their profits on that. So it's going to be offset. I don't know if it's going to be offset by a whole 6% of their revenue, but it might be offset by a couple percent, let's say. It could even offset more if they're able to get millions of users. So it just depends. One really cool thing about Charles Schwab is that they're the one that initiated this. So they have a plan. It's not like they had to fall back to a plan B or be reactive like TD Ameritrade and E-Trade, and maybe they weren't ready for this. Charles Schwab is a full bank, so they have a lot of locations. They have every type of service that you might want. That's why it's a small part of their revenue. And so Charles Schwab is just a really good, safe, and it's definitely one that I'd be interested in if I'm looking into moving my brokerage account. Now let's look at TD Ameritrade. TD Ameritrade is actually the one that's impacted the most in terms of the revenue that it's going to lose from not having commission trades. And they're going to be losing well over 20% of their revenue, and that's all that came from the commissions for the trades that they got. And TD Ameritrade has the best analytics and things that you want to do if you want to analyze stocks, price, and these type of charts. They really have a lot of information, and they're known to be the best in that area. But besides that, it doesn't separate itself too much from Charles Schwab and E-Trade. And so now moving to E-Trade. One interesting thing about E-Trade is that they have a really good platform, and not only that, they also have a high yield savings account. So I think their high yield savings account is like 1.7, either 1.7 or 1.75% right now. And so that's really interesting because whenever you have money sitting on the sideline, you could choose to open up that high yield savings account and then always push that money back to that high yield savings account. So when it's just sitting there, instead of the brokerage just using that money and gaining from that interest, because that's actually how most brokerages make money in general, besides the commission trades that they would do. Any money that's just sitting around in their account, let's say you have $1,000 just sitting in the account that's not being actively traded, whether it's from dividends that weren't reinvested or just any money that's just sitting out for a recent trade that you've sold and cashed in on, all that money that just sits there, they gain interest on that money there. And that's a big portion of their business. That's the number one way that Charles Schwab makes money. And Charles Schwab has a high yield savings account of, I think it's like 0.23%, which is very good compared to like Bank of America, Chase, and Wells Fargo, but it doesn't even compare to what E-Trade gives at 1.75, I think. So that's a really compelling argument for E-Trade. You have that high yield savings account, and they're impacted by about 16%, maybe a little more than 6%, but so in the middle between how much of an impact the revenue loss is going to be from Charles Schwab to TD Ameritrade. And now let's look at Robinhood and other like platforms like M1 Finance. So Robinhood is still a really good platform. And the reason why Robinhood and M1 Finance might be decent because they have a really good mobile app. So if you really care about the mobile app experience, those are going to be top notch. I would put some caution with jumping into Robinhood right now or M1 Finance. And the reason for this is twofold. One is that this disruption is happening, so the disruptor is now being potentially disrupted. They were disrupting these huge brokerages that would charge for all their trades. And now the disruptors are being disrupted by all these big brokerages who have proven track records that are now doing zero trade fees. And will this disrupt Robinhood and M1 Finance? Well, not until they come out with better mobile apps, or at least comparable mobile apps. So Robinhood definitely will still be around. I don't think they're going to go away anytime soon, but I would definitely be hesitant because, again, it looks like that there is definitely potential for the disruptor in the market to now be disrupted. And so that was a brilliant move by Charles Schwab and then these other brokerages to follow suit. These new startups, they were starting to make waves, and then they jumped back in to make sure that doesn't take over their business. Now, the second thing is that I understand wanting to get free trades from just starting out. Like I said, if you just want to invest $100, you don't want to spend 7% of your money on trade commissions. Now, on the flip side, you want to have a long-term vision. So right now you might have only $100 to invest, or let's say $1,000 to invest. But where are you headed? You should think of in the future when you have hundreds of thousands of dollars or even millions of dollars. Do you really want to have that much money in a app that's not proven itself? How long will it be there? You want to put that money in something solid. that doesn't mean that you can't, transfer your account later on. And you want to build your account into something, meaningful, and in the long run, it's going to grow into hopefully hundreds of thousands and even millions of dollars. And so you really want to trust where that money is and not worry about it. And let that just sit there and give you that financial security. So because of that, you want to make sure why not shoot for the best? And now that you have the chance to shoot for the best brokerage, because they're giving it away for $0 trades, choose the best one out there and the one that makes sense for you. Again, best one out there, a combination of how much of an institutional bank do you want it to be in terms of all the services that it provides, or if you're looking for that high yield savings account, or if you just want all the analytics. So it depends on which one you're going to choose. And so the one concern that I do have for free trades is that one might be more tempted to buy and sell more frequently and not follow your initial plan. Of course, you can deviate from your plan, given new evidence and new information that you didn't have before, or that came up due to the earnings or whatever it may be, but definitely not be impacted by the fact that trades are free and lose your plan and your discipline. One other thing is that just make sure that the trades that you do, especially if you're managing individual stocks, just know that individual stocks should be a subset of your portfolio, especially if you're starting out new. You should have most of your stocks, most of your investments in ETFs and mutual funds, maybe like 90% even, and have 10% to play with and invest with your own in your own stocks that you handpick to see if that's something that might be good for you and something that you want to continue to do, and that's more profitable than the stocks that you've been putting into the ETF. And just to see that, especially while you gain the discipline in learning how to trade and sell on your own with discipline. So just want to make that one caution about not trading too frequently just because the trades are free. And that especially is for a concern I have for new investors. Well, I hope you enjoyed this video, and these videos are for your informational purposes only and entertainment value, and thanks for watching. And if you like this video and want to see more content like this, don't forget to like and subscribe.